Hi, happy Wednesday, everybody. My name is Irene and I'm here with Jane Bofsky from Supporting Strategies. And today we're going to talk a little bit about loans and some different types of loans that we see our clients take and different various aspects of those loans and what to really look out for. And of course, as with anything that we discuss, everything is pretty case specific. So if you do have any questions about anything specific to your circumstance, or to your case, please give us a call or send us an email and we can definitely discuss anything specific to your case. Some of the loans that I see quite often have to do with business buy sells. So if a owner of a business is selling and we'll put a price of it for about $1 million or so, and the buyer is interested in buying the business, but they at this time don't have the full $1 million that they are whether willing to or able to pay. And sometimes that could be, we see that often in hospitality, where a lot of renovations are necessary and inventory has to be purchased. We do also see that in manufacturing as well as in healthcare. And a lot of the times the reason for that in healthcare is because you're still waiting for some accounts receivables to be paid from insurance and such. And so what we recommend in certain circumstances where there is a loan is to make sure that you secure your rights if you're the seller in the company itself. So if the buyer stops paying, what are you going to do? And sometimes that could be a security agreement to buy back the rights and the shares of the business. And sometimes that could be securing the promissory note itself. Oftentimes, we recommend to our buyers that they do not agree to any personal collateral, that they keep it only to the business itself. But then we always are asked by our sellers, well, what happens if the buyer runs the business into the ground and I don't want that company back? What do we do in the event that the only security is something that is now going to be worthless and we didn't receive the remainder of the money back? And so that's when we get really into looking into the various aspects of how do we actually secure this loan in these types of situations? How do we make sure that the money is in fact paid back and that the company is in good standing? Sometimes it's by allowing the old owner to still inspect books and records or giving them perhaps some voting rights as well. And another thing really to look out for in these types of situations is our maximum interest rates. So oftentimes, because of course there's a risk of what we just talked about, the business could become worthless. A business that was otherwise very profitable could be run into the ground by somebody that doesn't know what they're doing. And then you don't have anything to come back into. So of course, to offset that risk, oftentimes there is an interest rate. So I do warn to be very careful with the interest rates. There are usury laws, and if they are personal interest rates, they're of course usury that is more strict on a personal level than they are on a commercial level. They're much higher if it's a commercial loan, but it's still very important to make sure that the entire loan agreement is not going to be annulled simply because the interest rate had exceeded what is allowable by law. So Jane, I did want to ask you now, in terms of the types of loans that you might see with your clients, what types do you oftentimes work with and what is the accounting aspect of them?
Hi, thanks, Irene. Great question. So a lot of our businesses are taking up small business loans, and we discussed some of the SBA related loans that could have some lucrative rates. But in most instances, for example, I see two top loans on deck and I see cabbage loans. And so for both of these, they give up to 200 for on deck. They have about $250,000 that clients could get. It could get some low minimum credit score requirement, and then just 100,000 minimum annual revenue requirement. And so obviously for all of these loans, our clients need to have the books up to date. Everything has to be kind of shown, right? And for the cabbage loan, same thing. They could get up to $150,000 and their minimum credit score has to be 640, which is quite high. So, when the business is starting out or business has been kind of going on for a while, there could be some issues where the credit score is just simply not great. And in that cases, the banks will require to demonstrate some strong cash flow and again require some collateral to reduce the risks of lending. And sometimes they just have to pay a little bit higher for the rates that are currently going. And if it's something significantly low, we might have to look at some alternative options such as factoring, which is, really significant interest rates. So we do see some of our clients kind of looking at some of these loans. Sometimes they're trying to borrow from other businesses, but in all of these cases, they really need to show their cash flow. They need to make sure that they have collateral and the books to kind of like have it going. So another part about the bookkeeping for the loans. So when the company, a business is taking up a loan, the company that is actually taking the loan has to be recording it on the books. And so when you take a loan, it involves basically reporting the receipt of the loan and paying for the interest expense over time of the return of the principal at maturity. And so first, when we get the loan proceeds, we put it as a loan liability. So it incurs either a current liability, which is like short term when it's has to be paid within 1 year, or long term, which is longer term debt. And basically in return, they receive cash. So this has to be shown on the books and being tracked on the books of the business that took the loan. So basically, it has to be properly tracked, and it has to be sort of every, when some of our clients have the loans on their books, we have to make sure that everything is done on a monthly basis because we have to show their financials, and it has to be ready at any point that is being asked by the bank or the lenders or even the business owners that are currently wanting to see the cash flow. I hope that answered your question.
Yes, absolutely.
Again, if you guys have any further questions, feel free to reach out. Thanks.